You are watching the FinTech Magazine Show, brought to you by FinTech Magazine, InsurTech Magazine and BizClik Media Group. I'm Joanna England, and today we're bringing you all the latest news, analysis and opinions from the world of FinTech, right here on LinkedIn, YouTube and other digital platforms. Now, joining me today is FinTech and InsurTech editor Alex Clere. Hi Alex, how are you today?
Very good, thank you, Jo. Good to be back.
It's good to see you. So, just to remind you, do come and say hello by posting in the comments section, and tell us also where you're joining us from on the show today. And also go and vote in our LinkedIn poll, because we are going to be announcing the results of that at the end of the programme. So, Alex, can you just remind us what the poll is today?
Yeah, of course. So we've got lots of great content in the next couple of issues of the magazine, centered around the theme of women in business. So we decided to ask you, which investment space is most attractive, do you think, to Gen Z women? You've still got time to vote now on our LinkedIn page, so tell us what you think, particularly if you are a Gen Z woman, and we'll reveal the results of the poll later in the show.
That's great. And of course, the options are real estate, Bitcoin, stocks, or art. So interesting choices there. And as Alex says, we'll be sharing the results of the poll at the end of the show. So add your comments and your thoughts. But there's loads to talk about before then. So let's start by taking a look at the latest FinTech and InsurTech news. Okay, Alex, why don't you kick us off with the latest news story?
Yeah, of course. There is only one place to start, really, and it's the week's massive news about the collapse of crypto exchange FTX and the failed bailout from Binance. Now, a lot's been said and written about this story in the past week and a half. Really, the wheels were set in motion when rumours about FTX's financial health prompted crypto holders to withdraw $6 billion worth of assets in the space of just 3 days. That left the company obviously with liquidity problems. Now, there's a couple of different ways to look at this story. So from a consumer perspective, it leaves a lot of people in the lurch. Obviously, FTX was forced to suspend withdrawals, and many consumers have been left with thousands of dollars of their own life savings invested into crypto assets on the platform. From a market point of view, I suppose it's the latest bump in the road, really, for a very turbulent crypto landscape. We've already had wildly fluctuating valuations, and crypto is probably at an all-time low in terms of investor confidence. It's also, of course, a massive fall from grace in terms of FTX itself, which was trying to raise extra money at a valuation of $32 billion as recently as September. Concerns around due diligence caused crypto rival Binance to pull out of a potential bailout, and Sam Bankman-Fried, the founder of FTX, who's long been considered a little bit of a poster child for the crypto space, has had to step down as CEO. In his place, they've drafted in an insolvency specialist who wasted no time in accusing FTX of, quote, an unprecedented and complete failure of corporate controls. Now, the third way to look at this is in the broader context, obviously. Some people are suggesting that this sort of unwanted attention on the crypto space is going to accelerate crypto regulation somewhat. Alexander Waxman, a partner at law firm Gunnar Cook, told us this week that the fallout from FTX's collapse made concentration within the crypto market even more likely. He says that the crypto winters have a habit of shaking out weaker players, and points out that our current crypto winter has been going on now for quite some time already. He also raises the prospect that regulators will impose greater antitrust scrutiny on crypto if this continues. Now, obviously, it's still an ongoing situation, and we'll wait to see what, if anything, can be salvaged. But in all likelihood, it does look like bad news for the people, particularly the people who've still got investments trapped in FTX. And it's certainly a blot on the copybook for the crypto industry itself.
Yeah, I totally take on board what you're saying, and I agree, and I do think that while this recent issue with FTX hasn't been helpful, trust in DeFi is going to continue coming from a number of places. And then every time we see sort of like a failure within the marketplace, there's almost like a readjustment. So that's helpful. But I mean, there are also sort of the big banks getting involved too. So we've got JP Morgan has got launched its own cryptocurrency, and I believe N26 launched one literally, I think, about 2 weeks ago. So I think it's definitely a watch and wait, because I think that as big players enter and invest in the marketplace, I think trust will in general increase. But again, it's just something we all have to keep our eyes on. So great subject, but and something that we could probably talk about all afternoon. But let's move on now to InsurTech. So Alex, what have you got for us?
Yeah, of course. So our InsurTech story this week comes from the world of business insurance. Now, if you're a rapidly scaling business, particularly a small to medium-sized business, you take out business insurance cover at the beginning of the year, and the premium is determined by a static snapshot of your firm's turnover and profit and salary base and those sorts of things. So by the end of the year, when you come to renew your policy, you may well find that your business has actually outgrown the amount of protection you have. And if you had to claim against the policy, you'd likely be underinsured because of all those financial metrics moving. So there's now a pilot program taking place between 3 insurance players: technology provider Kodak, a specialist insurance broker Capsule, and insurance giant Aviva. They're preparing to test a proactive, real-time approach to business insurance. The new approach will involve businesses sharing access to the data in their financial software, so that's platforms like Xero and QuickBooks and Shopify, through Kodak's API. They say it will simplify the application process and give both Capsule and Aviva a real-time view of a business's size and performance, allowing them to provide the right sort of insurance cover, as the business grows. Obviously, it relies on companies being comfortable sharing access to their financial data through the API. But as soon as they do decide to take that leap, it should hopefully prevent businesses from becoming underinsured between policy renewals. The CEO of Kodak has been quoted as saying that the new approach has the potential to set a new precedent for business insurance. And as far as being underinsured goes, it's definitely an issue for businesses, particularly businesses where prices are under slightly more pressure. Smaller businesses are more prone to those sorts of economic movements. Pricing is always going to be more important for them. Aviva estimates that half of all SMEs in the UK alone could be underinsured, and Capsule says that figure rises to as much as 80% among companies who are experiencing rapid growth. So I think we're aware of the dangers of underinsurance. People are aware that they risk leaving themselves vulnerable if they have a need to claim on their policy, but that policy doesn't cover them as comprehensively as they think it does. But one of the interesting points that those 3 companies are trying to raise awareness of is the idea that actually many scaling businesses just become underinsured between policy renewals. They sort of sleepwalk into it, because by the end of the year, when you're growing, you're in a much stronger financial position than you were when you renewed the policy.
Yeah, that's very true. And I think that it's such an interesting concept. But you flagged up the need for greater trust within the ecosystem. And I think the results of this pilot are going to throw up some interesting results, because obviously giving your companies, giving an API access to your financial data might not be something that a lot of companies would be very keen on, considering how tricky the cyberspace is at the moment. But it's ever evolving, very interesting concept. So definitely one to watch. Now, speaking of watching, we'll actually be seeing you after the break with more FinTech and InsurTech news and details of our December issue too. So stay tuned.
I'm trying to identify opportunities to evolve the product and the servicing structure to reflect the needs of an evolving customer. I'm Sagar Rajgopal. I'm the President and Chief Customer Officer for Ubiquity Global Services. Ubiquity is a specialized outsourcing partner for a lot of entities in the financial services space. We do everything from technology support and development to customer experience management. I think what helps us really stand out in the space that we operate in is the fact that we understand the compliance landscape that a lot of our clients operate in. And within those constraints, we build processes, workflows, and customer journeys that allow them to maximize the benefits that they'd like to be able to deliver from a customer experience perspective. We've been partners with BankMobile for more than 7 years now. We have really developed a relationship based on taking the entirety of their customer-facing work and building and developing customer journeys that allow them to maximize the value that they're able to provide to their customers and to that particular audience. To help BankMobile build a richer and richer feature set into their core products.
Welcome back. Still to come, we have the results of our LinkedIn poll and more on the FinTech Live event. But first, we have this week's interview, and this one is actually a bit of a sneak preview of our December issue. Now, open banking is a hugely trending topic, and disruption in that space always makes for an interesting conversation. So I caught up with Daniel Shalane, who is the CEO and founder of Tink, for an in-depth conversation about the state of fintech and his journey as an entrepreneur within the space. So this is just a short excerpt, and you'll actually have to wait until our December issue is released before finding out more.
So Tink was acquired by Visa earlier this year. What changes is that bringing, and what changes will it bring to services and to the company as a whole?
I mean, we've had the opportunity, certainly we've been through ups and downs over these 10 years, mostly downs, but over the past few years, when we had good product market fit and tractions and delivered solutions to customers' problems, we've had a few people come knocking on our doors wanting to make acquisitions or similar. And we've always evaluated this through the same lens. Like, is this going to increase the likelihood of us winning and bringing open banking globally? And the answer previously was no. And with the Visa, that was different. Why? Because they believed a lot in this company and wanted to keep it independent, but also giving us the muscles and trustworthiness and the network that Visa has globally. And I think that's exactly what we got. And we still operate as a small, nimble company, but we can take a long-term approach. And I think that we spend a lot less time trying to kind of explain who we are, that we can be trusted, that we're going to be around 10 years from now, etc., and that we're compliant and all of that. And instead, people realize, well, you're part of Visa, and we can tick the box by that, and now we can focus on what can we do together. I think that's it's an amazing opportunity to, as I said, take that long-term global view together with a large organization and the people at Visa.
So that was a great interview, and there was so much interesting information that came out of that. And Tink is just going from strength to strength because customers want that seamless transactional mechanism. And I think it really is going to be a huge discussion point in 2023. I mean, Alex, what struck you most about open banking developments at our recent FinTech event?
Yeah, I think you said it there, really. I don't actually think consumers care that much about open banking. What they care about is open functionality. We're all used to being asked whether we want to share our details, whether we give permission for apps to access information about us. I think for most consumers, provided it's a supplier they know and trust, of course, and the uses of the data are being explained plainly, transparently, then I think consumers are generally open to sharing their data, provided they get some sort of benefit or some additional functionality in return. Like you said, it was a massive talking point at FinTech Live London earlier this month. We had speakers on open banking from Yapoli, Nordigen, OBIE and Clere, all talking about the state of open banking.
Yeah, we certainly did, didn't we? It was a huge topic. But now it's time to move on and take a look at what's going on in our FinTech and InsurTech magazines. So, of course, November's issues have been live for almost 3 weeks now. So if you haven't had a chance to check them out, head over to fintechmagazine.com and insurtechdigital.com to investigate those. And of course, December is nearly upon us, as is the December issue. So we're going to talk a little bit about that today. Alex, I'm going to hand over to you for it.
Yeah, of course. So as we see the magazine cover, you'll notice a familiar face, because it's actually Daniel Shalane again from Tink, and very purposely used that interview because he is the cover star for our next issue of FinTech Magazine. He talks to us about founding Tink, transforming the banking space, and about the successes they've enjoyed along the way. We're also profiling the revolution in mobile banking. Obviously, with smartphone adoption increasing and the rising popularity of digital banking is causing this mass rush, this hysteria for challenges to release more and more features and become more and more like super apps. So we've got Rapid and Papara sharing their thoughts on whether this slow march towards super app status is the right way to go for everybody. And we're looking at how fintechs can improve their resilience in challenging times. Obviously, the investment landscape isn't the sunniest it's ever been right now, so it does become harder for startups to attract reluctant investors amid tales of high inflation and rising interest rates. So we've enlisted some top industry insiders to give us their thoughts on building resilience in a trying market. We've also got a bit of silver lining, so we're showcasing the top 5 fintechs who are managing to still do relatively well despite the difficult circumstances. All of that, plus we've got our usual look back on the month gone by in FinTech. That's in the December issue of the magazine.
Great stuff. And I'm actually really excited to see the event roundup review, because that's coming out in the December issue. And we just had so many amazing speakers and panels for FinTech Live 2022. And I learned so much over those 2 days earlier this month, and it's been great fun for me to look back over it. But we don't have a huge amount of time today, so let's dive into the poll results. Alex, can you please refresh our memories and give us the numbers?
Yeah, of course. So a little bit earlier in the show, we teased you with the LinkedIn poll, which was, of course, which investment space is most attractive to Gen Z women? And the options we gave you were A, real estate, B, Bitcoin, C, stocks, and D, art. So we've got the results back. We've had over 400 votes, so thank you to everybody who took part in that. And the statistic breakdown was as follows. Real estate was top with 44%, followed by stocks on 20%, which just beat out Bitcoin on 19%. And the lowest answer was art on 16%. But those last 3 answers very, very close.
They really were, and actually these are really interesting results, because I was a bit sneaky when I decided to ask this question as part of the poll, because I already had a study sent through that has surveyed the investment interests of Gen Z women. So I thought it would be interesting to make a comparison between the actual numbers from a widespread study to what our audience opinion was, just to see really how on the nail they were. I think the survey that we got back, which was obviously from the Banking Times, shows that the results are really close. There are a couple of results that haven't quite hit the nail on the head, but so things like real estate, that was 41% of Gen Z women want to invest in real estate. Number 2, the biggest investment was Bitcoin, amazingly, which I think is really interesting. Again, goes back to our discussion on trust in the DeFi space. Gen Z women are really interested in investing in Bitcoin and cryptocurrency as a whole, but obviously Bitcoin is the favored one. The third most favored one was stocks, which was 12%, and the least most favored was art, which was 8%, which still isn't bad, and art is obviously still a good investment space to put your money in. But I just think that these are figures that really show that there is clear movement actually towards mainstream cryptocurrency going mainstream? Because if women are into DeFi, and let's face it, we are the big spenders. We are, in general, all the surveys show that the women are the ones that manage the household budgets, and women are the ones that make the big financial decisions in terms of running things. And I think really that means that crypto will have to go mainstream to the high street quite quickly. What's your take on it, Alex?
Yeah, I mean, just picking up on the numbers you mentioned there, I think our audience has done fairly well. There's only 1% between Bitcoin and stocks, and I think they picked out the top investment opportunity, real estate there. So against what I'm assuming is probably a slightly larger sample group, I think they've almost hit the nail on the head. I think possibly the difference in risk appetites between generations, between genders, I think maybe it's slightly overplayed a little bit. You know, most people, I think, probably have quite similar levels of risk appetite and very similar understandings of the rates of returns that they're going to get for each of these different asset classes. It's just more, I think, about the way people invest, where they invest and how, that differs slightly based on where you are or who you are.
That's right. Sage advice there, Alex. So moving on quickly now, can you believe it's been almost 2 weeks since we closed the FinTech Live show in London? I mean, it really feels like it was yesterday, and we had some great speakers and lots of packed sessions. And just a reminder that if you want to rewatch any of those sessions, you can catch up on them on Brella, which is the app that we used at the event. And excitingly, we've also already announced the dates for FinTech Live 2023. So make a note of that in your diaries. Next year's event will take place from the 8th to 9th of November 2023, and you can already register your interest. So you can go to fintechmagazine.com and click on Live in the main menu, and we'll keep you informed about FinTech Live 2023 closer to the time. And of course, in time-honoured tradition, the only thing left for us to do now is the end of the show, which I believe is Alex's domain this week. Alex, would you like to reveal all?
Yes, of course. Unfortunately, Joe, you're my victim this week, and you're going to be subjected to the end of the show, whether you like it or not. And this week, we're going to do a twist on the classic game, Would You Rather? But instead of the daft questions that you usually get in Would You Rather, we're going to ask some fintech and insurtech related questions instead. So if we can have the first question on screen. So what would you rather have, Joe? Would you rather have 10,000 Ethereum or 1,000 Bitcoin? I'm feeling very generous, so I'm going to give you a choice between 10,000 Ethereum or 1,000 Bitcoin. What would you rather have?
Oh, I'm going to go for the Bitcoin.
You're going to go for the Bitcoin?
Yeah. I know that there have been some really interesting changes in Ethereum of late. And I know that it's a really strong currency, but Bitcoin has kind of stood the test of time. And I really am attracted to that sort of slightly more edgy proof of work type currency. So okay. Yeah, I'm going to go with Bitcoin. What would you go with?
Oh, well, it's very difficult for me to say because I know what's worth more. And This is the reason I asked the question. There's some good emotional arguments there, but if we can skip ahead to the answer, you'll see the purely factual argument is the one you chose, 1,000 Bitcoin. So you did indeed pick the right answer. 1,000 Bitcoin, just for information, would currently be worth, although this was 20 minutes ago I checked, so it may have changed since then, currently worth $16.5 million, while 10,000 Ethereum would be just 12 million. So you would definitely prefer 1,000 Bitcoin, although you wouldn't really turn your nose up at either of those two sums.
No, to be honest, I wouldn't, but good question.
Let's move on to question 2 now. So question 2 is insurance related. So we've looked at the average claim for home insurance. Now, I'm sure you'd probably prefer neither, but if I forced you to choose, would you rather your house was damaged by water or by wind?
I think I would rather it be damaged by water. And from where I live in Norfolk, I'm much more likely to have my house damaged by water because it rains quite a lot. And actually, I know that there are some really great insurance policies out there at the moment that I could potentially cover my house with that would give me really good protection and affordable protection in the event of something like that happening. But what would you do?
Well, I think there's a tendency, isn't there, to associate flood damage a little bit along the lines of fire damage. Oh, it's going to completely gut your house. So I think people are, obviously we don't want it to happen to anybody, but if we skip along to the answer, you'll see that you are spot on to go with flood. Neither is a pleasant experience. Yeah, you're 2 for 2. But according to Experian, the average claim for wind and hail is $11,695. The average claim for water damage and freezing is $45 less. And of course, that doesn't compare to fire and lightning, like I mentioned, which on average causes damage worth $77,000. So
Nice.
You're much better to be flooded or to have a little bit of a storm hit your house than for it to be completely gutted by fire. So let's move on to question 3 now. So we're talking about smartphone adoption now. And this will test your knowledge of flags. Would you rather be a neobank in Vietnam or Turkey? Which do you think is the bigger market?
A neobank in Vietnam or Turkey? Do you know what? I'm going to go for Vietnam. And I'm going to go for Vietnam because I know that the APAC region is really, really hot on mobile adoption. And therefore, although there are issues with financial inclusion, those are being addressed with mobile banking apps. But I'm not so hot on the Turkey data, so go and enlighten me.
Well, you could have fooled me because you've got another correct answer. The answer is indeed Vietnam. According to Statistica, smartphone adoption in Turkey is 64.8%, but in Vietnam it's 68.2%. When you account for the difference in population between the two countries, that means there are more than 11 million more smartphone users in Vietnam. So we're playing for the full sweep now, Joe. Don't know if this is beginner's luck or what.
Is that it? Were there only 3?
No, there's 4. So you've got one more
okay.
to get the 100% record. So let's move on to the next question, and we're finally back to insurance. Now, this is the sort of question you might find in an ordinary game of Would You Rather. Would you rather, when it comes to insurance, have a cat or a dog?
A cat. A cat, and I can tell you that because I have both a cat and a dog, and my cat's insurance is a lot less than my dog's insurance. So I would be on a purely financial basis. I would definitely rather just have to pay for cat insurance.
It sounds like you've lived the experience. You've got the tale to prove. Absolutely right. The answer is indeed a cat. According to Value Penguin, which is a personal finance website, the average cost of accident and illness cover for a dog is $50 per month. And for a cat, it's just $28 a month, almost half the price. I don't know if that compares to your experience, but there we are. That answers that age-old question. A cat, apparently, in insurance terms at least, is better than a dog.
Yeah, no, absolutely, absolutely. In fact, I think I pay even less than that for my cat and even more for my dog. So there's a much bigger gap there. And I've done obviously quite exhaustive research in terms of what would be the best policy, but there we go. But anyway, great game. Well done. Well done. Okay, so that's all we've got time for in today's show, because unfortunately we've run out of time. And as always, it's been a pleasure. So thank you to Alex for a great game and for all those insightful pieces of information on the latest news. And of course to the production team who've done a terrific job today. We'll be back next month with more fun FinTech facts and news. And of course, happy Thanksgiving next week to all of our American viewers. So until next time, bye for now.